Watching Closing Bell on CNBC. First in business worldwide.
Up next, he made his fortune in hedge funds. So why is the head of SAC Capital Advisors, Steve Cohen, now warning investors? Reaction to his latest prediction next. His billionaire Steve Cohen of SAC Capital Advisors is hinting that the glory days for the hedge funds are just about gone. In rare comments to the Wall Street Journal over the weekend, Cohen said it is hard to find ideas that aren't picked over and harder to get real returns and differentiate yourself. We're entering a new environment. The days of big returns are gone. So is the party truly over for hedge funds altogether? Joining me now to talk about it is Charles Gradante, co-founder of the Hennessy Group. Charles has appeared before the Senate, House, and SEC on hedge fund and long-term capital. And Edward Chancellor, deputy U.S. editor at Breaking Views, and also the author of the book, Devil Take the Hindmost, A History of Financial Speculation. Nice to have you with us, gentlemen. Welcome to the program.
Hi.
Let me get your thoughts first off on Steve Cohen's comments in the Wall Street Journal. Charles, what'd you make of that article?
Well, first of all, Lee Hennessy sends her regards and love the Success magazine cover story on you. Congratulations, Maria.
Thanks very much.
The article, look, he's making a good point. Bigger is not better if you're a day trader. Sizes of hedge funds have gotten to the point where the Warren Buffett buy and hold strategy is the only way to go if you're managing $8 billion. You can't day trade $8 billion. And a guy like Stevie Cohen is being marginalized because he's not managing the entire portfolio. And he is the best trader in the entire hedge fund. So as he got bigger, he marginalized his own brilliance.
Well, it's interesting, Edward, because over the last couple of years, really, we have been hearing that so many people have been coming into this business, and there has been speculation that there are, in fact, too many hedge funds out there, and that is one of the issues. What do you think about that?
Yeah, I largely agree with that. I mean, investment is a zero-sum game. The more people who play the game, they just end up picking each other's pockets. The thing about hedge funds is that they pick each other's pockets with very large fees. Now, Stevie Cohen is a trader. He was really just complaining that there's too much short-term trading going on for him to make profits. He's grown his fund very, very large. I suppose in a perfect world, he might return some of those funds, let's say 90% of those funds, to his investors and carry on earning decent returns with a smaller sum of money. Instead, he's decided to be an asset gatherer, as we say, and charge his large fees on a bigger sum, but warn his investors that they're going to get smaller returns in future.
So is that the right call?
Well, I don't think that Mr. Cohen's going to be hurt by it. I don't know. He's obviously made his investors a great deal of money to date. I don't know. He has an egregiously large fee structure. He doesn't seem, as far as I know, he doesn't have the qualities of being the core skills of being a long-term investor. He's been a short-term trader. Whether he can justify his fees with a complete, different strategy is another matter. So I'd be suspicious.
Maria? Yeah, let's not forget that the equity market, whether it's the hedge funds or long-only managers, the equity market is a discounting mechanism for inflation. And when we talk about performance in equities, we really should talk about performance relative to inflation. When we had the S&P 500 performing at 12% on an annualized return, we also had inflation of 4, 5, 6%. So relative to inflation, hedge funds and the stock market have done very well, even on an after-tax basis. So although the returns have been marginalized, we have to compare it to inflation. You give me a steeper yield curve, not a flat one, and you give me more volatility in the market, and I'll give you higher returns.
It's a great comment, Edward. Let me ask.
Can I just say I don't believe that for one moment. I think hedge funds have been eking out their returns in recent years by selling short volatility. What one sees is that more and more hedge funds of completely different strategies are both correlated with each other and correlated with the S&P 500. And I expect when inflation picks up and volatility picks up, that a great number of hedge funds will go down together, to many people's surprise.
Well, let me ask you your thoughts on that idea. You know, there has been speculation in the market recently that there is another long-term capital management sort of looming, and we could see a disruption in this market. Given the leverage we're talking about and the number of hedge funds out there today, do you worry about that?
Well, everyone worries about it. The trouble is, last week the president of the New York Fed was worrying about margin requirements and hedge funds. You speak to the investment banks who manage the prime brokering that look after the leverage of the hedge funds. They say there's nothing to worry about. And I suppose the fact that Amaranth has blown up and lost as much money, if not more, than long-term capital management without creating a sort of systemic crisis is a reason, is a cause to rejoice. I think the bigger risk is, as I say, unexpected correlations where everyone has to rush for the door at the same time. And that, in a way, was what Steve Cohen was also talking about. He said, the hedge funds have gotten so large that they've got very large positions in the same stocks and the same type of strategies, and therefore one of the things that happened with LTCM is that as everyone tried to sort of withdraw their money after LTCM, it created correlations between different styles that didn't exist before, and I think that is a risk. Yeah.
Now, look, I testify. Maria, I testified before the House on long-term capital. I don't believe there's a long-term capital out there unless we're talking about the credit default swap markets. But it's very important to understand that hedge funds have a low correlation to the S&P 500, although they're not absolute return strategies, and that's been a misperception for a long time. Hedge funds are relative strategies; they're just less relative than other strategies.
Well, the question of how much they represent in terms of volume is certainly a different issue. But gentlemen, we will cover that on our next meeting. Thanks so much for joining.